The main message for investors is this: crypto can be a good ingredient in a portfolio, but a little goes a long way.
Hi, I'm Zach Pandel,
And I'm Michael Zhao.
and we are here from the research team at Grayscale Investments. Building a compelling and diversified portfolio has gotten harder for a bunch of different reasons. These include the end of the long bull market in bonds, more narrowly concentrated gains in the equity market, and higher correlations across asset classes, which limit the opportunities for diversification. Some institutional investors have taken steps to try to address these challenges, like investing in private assets, private equity, private credit, or real estate, or by using leverage, which means borrowing to enhance returns. But these options are not always available to every investor. At Grayscale, we believe that the crypto asset class can be a helpful ingredient in building a high-quality, diversified portfolio today. Crypto assets really expand the spectrum of risk and return that's available to every investor in public markets. Investors face a familiar trade-off between risk and returns when they're looking at traditional assets, whether those are stocks or bonds, for example. Crypto is further out the spectrum, meaning that it offers the potential for higher returns for investors that are willing to take more risk. Crypto also offers a relatively low correlation to traditional assets. For example, over the last 5 years, Bitcoin, one digital asset, has had a correlation with the S&P 500 of just 0.4. Assets that have relatively low correlation can be combined together in a portfolio to provide more diversification. So it's really these combination of things that make crypto so compelling in a portfolio context. The asset class offers high risk and high return potential, but also a low correlation with other risky assets. Some assets provide low correlations, but not as compelling returns. Other assets may provide high returns, but a high correlation to stocks. It's this combination of high returns, high risk, and low correlations, which makes it a good ingredient in a portfolio.
So to consider the right amount, we looked at the data and ran some classic portfolio optimization tests. This involves simulating a number of possible future outcomes for portfolios and considering the effect of adding Bitcoin. Over the thousands of combinations that we tested, we found that an allocation to Bitcoin of around 5% was about right in multiple future scenarios. Around that amount of Bitcoin allocation produced the best risk-adjusted returns in terms of Sharpe ratio. The main message for investors is this: crypto can be a good ingredient in a portfolio, but a little goes a long way.
Thanks, Michael. I'd just say additionally that there are many different types of investors with different goals and needs, and you should think about your own circumstances before investing in the crypto asset class.
Thanks for listening.